Usually when we talk about global supply chains, there is this massive, almost unavoidable expectation of friction. I mean, if you look at North American and European businesses right now, it is, well, it's an absolute battlefield out there.
Oh, absolutely. It's a highly reactive environment. I mean, supply chain managers are basically fighting tooth and nail over factory capacity.
Right. And they're suffering through like endless tariff whiplash. It seems like every logistics meeting inevitably turns into a crisis negotiation.
Yeah, exactly.
Yeah.
Every time a new geopolitical headline drops, their margins just take an immediate hit. They're essentially playing defense 365 days a year, which
Yeah.
is, incredibly expensive.
And exhausting. But then you look south and you realize that while the rest of the world is caught in this massive global traffic jam, Australian importers are quietly sitting on a massive structural advantage.
A huge one. And the fascinating part is that it's been hiding in plain sight for years.
Literally in plain sight. So, welcome to the deep dive. It is Tuesday, June 9th, 2026. And today we have our hands on a really fascinating new 2026 report that breaks down Australia's ultimate sourcing secret in Vietnam.
It's a great report. It really lays out the mechanics of what's happening.
It really does. So, our mission today is to figure out exactly how and why Vietnam exports to Australia have exploded by an unbelievable 388% over the last 15 years. And, more importantly, we are going to explore how this is completely rewriting the rules of retail and supply chain economics for you, the listener.
Right, whether you are directly managing retail inventory or just trying to understand the deeper currents of global trade.
Exactly. Okay, let's unpack this.
Well, the core premise we really need to establish right up front is that this 388% growth it's not some historical accident.
Right.
It's not a lingering fluke of post-pandemic recovery either.
Right.
What we are looking at is a deliberate, highly calculated masterclass by Australian businesses. They are perfectly leveraging geography, free trade agreements, and honestly, immaculate timing.
Yeah, and we should establish the sheer physical scale of this shift before we get into the mechanics.
Yeah.
Because saying something grew by 388% can sound like, I don't know, just another abstract statistic.
Visualize, yeah.
Right. But let's look at the actual volume of goods moving across the ocean here. Back in 2010, Vietnam exports to Australia were sitting at about $3.2 billion. By 2025, that number skyrocketed to $15.6 billion.
Which is just a massive leap. And total two-way trade hit $24.8 billion.
Right, and the projections for this year, for 2026, they are estimating that exports alone will cross $17 billion. That is a 20% year-over-year growth trend, showing zero signs of slowing down.
And we aren't talking about like small boutique shops driving this volume.
Yeah.
The players utilizing this corridor are the absolute heavyweights of Australian retail.
Like who?
Companies like Kmart, Target, Harvey Norman, Bunnings. I mean, these are massive corporations that move millions of physical units a month.
Wow, yeah.
So to sustain those volumes, they've had to entirely re-engineer their global footprint.
But I keep coming back to the gravity of China's manufacturing infrastructure. It's so deeply entrenched. We have seen supply chains shift before when tariffs get unpredictable, but then they often revert back.
Right. They go back to China.
Exactly, because no one else has the roads, the ports, and the raw workforce to sustain it long term. So I have to ask, is this really a permanent structural shift for Australia or just like an extended vacation while U.S.-China tensions simmer?
If we connect this to the bigger picture, we see that a reversion to China is actually highly unlikely for these specific retailers. You really have to look at the underlying motivation here.
Okay, which is what?
These companies are actively migrating to preserve their margins against global inflation. And in doing so, they have locked in what is essentially a three-pronged advantage that China just can no longer offer them.
Okay, lay those out for us.
First, they have secured a massive tariff advantage. Second, they have unprecedented shipping speed. And third, they have achieved geopolitical insulation. So, yeah, the initial U.S.-China tensions might have been the catalyst, but the economic reality in Vietnam was so far superior that it turned into a permanent migration.
Wow. Let's dig into that first prong, the tariff advantage. Because the report points out that the primary financial engine driving this entire explosion is an obscure but incredibly powerful free trade agreement.
Yeah, it might be obscure to the general public, but it is the absolute bedrock of this specific trade route. It's called AANZFTA. That stands for the Asian, Australian, New Zealand Free Trade Area.
For the listener who might not be deep into international policy, let's break down ASEAN quickly.
Sure, IGN is the Association of Southeast Asian Nations. It's basically a political and economic union of 10 member states in Southeast Asia.
Which obviously includes Vietnam.
Exactly. Now, AANZFTA was signed back in 2009. But what makes it so revolutionary today is that it allows 90% of Vietnamese goods to enter Australia at zero or entirely negligible tariffs.
Wow.
We're talking 0 to 2% at the border.
Which is staggering when you compare it to what the rest of the world is dealing with right now. I mean, the report lays out the comparisons. If you're a U.S. importer bringing in goods from Vietnam, you're facing a base rate of 5 to 6%.
And that can easily shoot up to 20% or more on specific categories, right? Like apparel or furniture.
Exactly. And if you are importing from China, you are looking at 19 to 35% tariffs depending on the product.
The mathematics of this are incredibly simple, but the impact is just profound. Australian importers are benefiting from structural tariff advantages that North American competitors simply cannot access.
It's widening their profit margins before the product even goes on a shelf. I sort of look at it like driving on a highway, you know? Well, the U.S. and European importers are stuck on this incredibly steep toll road. They have to pull over and pay premium fees at every single checkpoint just to get their goods to market. Meanwhile, Australian importers have this private VIP fast pass lane where they are just walking right onto the ride for free.
That's a perfect way to put it.
Let's walk through that dining chair example from the report because this really grounded the math, see? Imagine a Vietnamese furniture manufacturer selling a basic wooden dining chair for $50.
Okay, let's trace that chair. If that exact $50 chair is put on a ship bound for an Australian importer, AANZFTA dictates that the importer pays maybe $0 to $1 in tariffs. It is practically a rounding error on their balance sheet.
Right.
But if that exact same $50 chair from the exact same factory floor is put on a ship bound for a U.S. importer, the U.S. importer is slapped with $10 to $12 in tariffs upon arrival.
And that $10 to $12 eats directly into their profit margin. Because the Australian retailer is saving that money, they have incredible pricing power. They can price their products 15 to 20% lower than North American competitors and still maintain their margins.
Or even expand them. It completely changes the unit economics of retail.
Yeah.
And, we should add that Vietnam isn't isolated here. They have a very dense network of free trade agreements globally.
Right, over 15 of them, I think.
Yep, over 15. They have agreements with Japan, South Korea, the EU, the UK. They are part of CPTPP and RCEP.
Let's define those quickly because those are massive acronyms.
Oh, right. CPTPP is the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. And RCEP is the Regional Comprehensive Economic Partnership.
Got it.
It's basically a massive unified market that covers nearly a third of the world's population across the Asia-Pacific. So Vietnam is incredibly well connected.
Yeah.
But even among all those agreements, AANZFTA is uniquely valuable.
Wait, if Vietnam has 15 other major agreements linking them to, like, Europe and Japan, what makes the Australian one the golden ticket?
Because AANZFTA is the only major free trade agreement where Australian importers receive tariff benefits specifically on labor-intensive goods that North American and European competitors do not get.
Oh, wow. Like, what kinds of goods?
Think about apparel, footwear, furniture.
Right.
Over 65% of Vietnam's export value to Australia is wrapped up in those highly labor-intensive goods. So while a U.S. or EU importer is facing a 5 to 20% penalty on those exact identical products, the Australian importer is paying zero. That is the true arbitrage.
Okay, so the financial arbitrage is clear. The tariff toll booth basically doesn't exist for Australia. But I mean, a completely tax-free product doesn't really matter if it takes a month and a half to arrive, right? Which brings us to the operational arbitrage.
Exactly. The actual geography of moving these boxes. You can have the best margins in the world on a spreadsheet, but if your capital is tied up in a shipping container somewhere in the middle of the ocean for 45 days, your business is suffocating.
And the geographic advantage here is what really blew me away. Shipping from Da Nang or Ho Chi Minh City to Sydney takes just 5 to 7 days.
It's incredibly fast.
Compare that to the traditional sourcing routes from China. From Shanghai to Sydney, you are looking at 12 to 18 days.
Right, and that speed differential is fundamentally altering how Australian retailers operate. This is where the theory of supply chain management becomes actual on-the-ground reality.
Because of that transit time.
Yes, because of that 5-day transit time, we are seeing 3 completely transformative operational models emerge. Take the direct dropship model, for example.
If I'm selling, say, fast fashion, How does this 5-day speed actually change my daily operations?
Well, it changes everything. You can have a customer in Sydney order a product online on a Monday morning.
Yeah.
The factory in Vietnam fulfills it directly, and the shipment departs the port by Wednesday.
Okay, so it's on the water.
Right. It arrives in Sydney by Monday evening, and it's delivered domestically to the customer's doorstep 2 to 3 days later. That is a total supply chain of 7 to 10 days door to door across international borders.
Which means my inventory holding cost is effectively zero because I'm not storing it in a local warehouse. That completely rewrites how I manage cash flow for my business.
Hmm.
I'm not tying up millions of dollars in stock that might not even sell.
Exactly. You are freeing up massive amounts of working capital.
Yeah.
And that leads directly into the second model, which is regional fulfillment.
How does that one work?
Instead of trying to play a guessing game and predicting consumer demand 6 months in advance, an Australian retailer can just maintain 1 or 2 months of core inventory in regional fulfillment centers in Sydney or Melbourne.
Because they know they can restock instantly.
Right, because it only takes 5 days to replenish from Vietnam. They can reorder weekly based on actual real-time sales data.
You are matching supply to actual demand rather than projected demand.
Yes, and this results in inventory turning over 4 to 5 times annually. The working capital required to run this model is 40 to 50% lower than traditional China sourcing models.
That is wild.
And then, for the larger, bulkier items, you have the hub and spoke model.
This is where the report mentions cross-docking. For the listener who isn't managing a warehouse, what does cross-docking actually look like in practice?
Imagine a massive warehouse floor. Traditionally, a truck unloads pallets of goods. Workers put those pallets onto high storage racks, and they just sit there for months until a store needs them.
Right, collecting dust and costing money.
Exactly. With cross-docking, those pallets come off the inbound shipping container and are instantly sorted directly onto outbound domestic delivery trucks. The product never sits on a rack. It never goes into long-term storage.
So under this hub-and-spoke model, Australian importers consolidate massive shipments at the port of Da Nang, ship them over in 5 days, cross-dock them immediately, and then do the final mile delivery.
Yes. And the report notes that doing this reduces the shipping cost per unit by 60 to 70%. This geographic reality is why China cannot compete. You cannot physically move Shanghai closer to Sydney.
Here's where it gets really interesting. I look at this shipping speed differential, and it feels exactly like the transition from dial-up internet to broadband.
Oh, that's a great analogy.
Right. When we went from dial-up to broadband, we weren't just loading the exact same web pages a little bit faster. It completely changed the architecture of what you could build.
Well,
It made video streaming possible. It made cloud computing possible.
it completely opened up the landscape.
Exactly. This 5-day shipping lane is the exact same thing for retail logistics. You aren't just moving traditional boxes faster. You are operating a fundamentally different business model with almost zero working capital tied up on the water.
That is spot on. You are unlocking operational capabilities that your competitors just do not have the physical infrastructure to replicate.
So we know the financials are incredible and the speed is unbeatable. Let's look at what is actually inside these shipping containers. Because it's not just cheap t-shirts anymore.
No, not at all.
The report outlines the top 5 categories that make up $13.3 billion of that $15.6 billion total. I want to run through these because they really illustrate the maturity of Vietnam's manufacturing. Let's start with footwear, which is huge, at $4.2 billion.
Right, that's almost 60% of Australia's footwear imports. You've got Nike, Adidas, and local brands like Rivers all utilizing this.
And then apparel and textiles accounts for $3.8 billion.
What is crucial to understand about the apparel sector in Vietnam is the vertical integration. For a long time, emerging markets would just do the final assembly. They'd import the raw fabric from China, cut it, sew it, and ship it.
But Vietnam has moved past that now.
Oh, completely. They now produce the fabric themselves, they spin the yarn, they dye the textiles, and they do the final assembly all within their own borders.
Which cuts out an entire international leg of the supply chain.
Exactly. That vertical integration gives them a massive lead time advantage. An apparel order in Vietnam has a 45 to 60-day lead time from design to shipment. Compare that to Bangladesh, which relies heavily on imported raw materials. They're sitting at 60 to 75 days.
That makes total sense. Now let's look at a completely different category. Furniture and RTA, which stands for Ready to Assemble. This is a $2.1 billion category. Flat pack furniture is exploding, and Vietnam has captured 42% of the market. Why is bulky furniture suddenly migrating here?
What's fascinating here is the physics of shipping. When you are shipping heavy wooden furniture, you are essentially paying to ship empty space.
Right, it's so inefficient.
Extremely. If those bulky items were on the water for 18 days from China, your logistics costs just eat your margins alive. But because Vietnam has that 5-day shipping lane, domestic drop shipping for heavy furniture actually becomes viable.
Capturing 42% of the Australian flat pack market really proves that Vietnam has evolved far beyond light assembly. They're dominating complex, heavy logistics.
Absolutely. And that evolution brings us to the fourth massive category, electronics and components, sitting at $1.8 billion. We are seeing huge global players here, Samsung, Intel, Foxconn.
And the fifth is food and beverages at 1.4 billion, right? Stuff like coffee, chocolate, seafood undercutting competitors because of the zero tariffs.
Exactly. But going back to electronics for a second, that sector is heavily driven by government policy. Vietnam recognized the opportunity to capture high-tech manufacturing, so they introduced really aggressive incentives.
What kind of incentives?
We are talking about extensive tax holidays, subsidized land leases for mega factories, and big investments in technical workforce training.
So companies like Foxconn can set up a massive campus with favorable tax structures and then utilize AANZFTA to route those electronics straight down to Australian distributors.
Which of these categories is the most surprising to you, though? And why should the listener care if they aren't, in retail? Well, the furniture and RTA category is definitely the most surprising. It proves that Vietnam isn't just about cheap labor anymore. They are dominating areas where shipping speed directly dictates the retailer's bottom line. Anyone managing a business needs to understand how speed can offset physical logistics costs.
That's a great point. But wait, if this is also profitable, the secret has to be out. There's no way Australian importers are the only ones noticing these margins.
Oh, the secret is absolutely out.
Right, which means these factory floors must be getting completely chaotic right now with global buyers trying to get a foot in the door.
That is precisely why this report is written with such a severe sense of urgency. We are looking at a critical, rapidly closing window of opportunity between 2026 and 2027.
Because manufacturing capacity is filling up fast.
Exactly. Across Vietnam's prime industrial zones, capacity is maxing out, and port congestion at Da Nang and Ho Chi Minh City is steadily rising.
And naturally, when demand goes up, costs go up. The report notes that labor costs in Vietnam are currently increasing by 8 to 12% annually.
Yep. And those incredibly efficient 45-day lead times we just talked about, they're starting to stretch out to 60 or 75 days simply because the factories are overbooked.
Which brings us to the aggressive action plan the report outlines for 2026. If an Australian importer wants to secure these advantages before the window shuts, they have to move in phases, right? Starting immediately.
Right now, phases 1 and 2 need to be executed between now and Q3. This involves auditing your current China contracts, identifying exactly where that 15 to 20% tariff savings exists in Vietnam, and negotiating pilot orders.
Just small runs, right? Like 100 to 500 units to test the waters.
Exactly. You have to validate the quality and prove that the 5-day cross-docking logistics actually work for your specific product.
And once you validate the logistics, phases 3 and 4 take over from Q4 through 2027.
This is the lock-in phase. You transition from pilot orders to establishing 12 to 24-month supply agreements. You scale Vietnam sourcing to 40 or 60% of your total supply to secure volume discounts.
And then you take all those massive tariff savings and reinvest them into marketing to further drown out your North American competitors. So what does this all mean?
This raises an important question about the fundamental economic reality of the late adopter penalty.
How so? If you are listening to this and you're in a strategy meeting looking at your supply chain, how do you apply this ticking clock?
Well, right now, factories in Vietnam still have a marginal amount of capacity. Because they want to lock in long-term revenue, they have an incentive to offer pricing discounts to secure guaranteed multi-year volume.
But by Q4 of 2026 or early 2027, those factories will be completely saturated. They will literally be turning buyers away at the door.
Precisely. If you wait until 2027 or 2028 to make this shift, you will be hit with the late adopter penalty from both sides. First, you will be paying 2028's heavily inflated labor prices.
Ouch.
Second, you won't get any volume discounts because the factory doesn't need your business. And third, you'll be suffering through 90-day lead times because you're at the back of the production queue.
So the structural advantages of the zero tariff agreement and the 5-day shipping lane will still exist, but the golden window to secure your pricing power will have completely vanished. You are basically fighting for scraps at premium prices.
Exactly. Long-term contracts signed right now freeze your labor costs and protect your margins while inflation accelerates everywhere else.
It is a phenomenal breakdown of how all the pieces fit together. To recap the journey we just went on for you listening, Australian importers have taken a 2009 trade agreement AANZ FTA and combined it with a 5-day shipping lane to Sydney.
A really potent combination.
It really is. By doing so, they have created a 388% growth engine that entirely bypasses the steep tariff toll booths, the massive inventory holding costs, and the geopolitical crossfire plaguing North America.
They are dropping working capital, utilizing drop shipping for bulky flat pack furniture, and locking in margins that their international competitors just physically cannot touch. It's really a perfect storm of trade policy, geography, and sharp execution.
But understanding this massive shift does leave us with one very provocative final thought to consider.
Yeah, we've seen how rapidly Vietnam has evolved, vertically integrating their textiles, capturing high-tech electronics, all to absorb this global manufacturing.
Right, but if their capacity completely fills up by 2027 and their labor costs continue to surge by 10 to 12% every single year, where does the cycle go next?
Does Vietnam eventually become so wildly successful, so advanced, and so expensive that they have to start outsourcing their own lower-level manufacturing to newer emerging markets?
Yeah.
Do they, in essence, inevitably become the new China?
That is a fascinating cycle to picture. The center of gravity just keeps pushing further and further outward. Thank you so much for joining us on this deep dive today. We hope this gave you a whole new lens on how global trade actually moves.
It definitely changes how you look at everyday items.
Absolutely. The next time you are sitting on a new flat pack dining chair or lacing up your running shoes or checking out the labels on your electronics, maybe think about the incredible zero tariff 5-day sprint it took to get that product to your door while the rest of the world is still sweating it out in the standby line. Catch you on the next one.